During the first 9 months of 2022, Warren Buffett's Berkshire Hathaway funneled a massive $66 billion towards the purchase of equity securities or stocks. And although that number's offset somewhat by the $17.3 billion in sales they've made in the first 9 months of 2022, the net amount purchased of $48.9 billion remains a pretty comfortable record for Berkshire. In fact, it really pales in comparison to what they've done in previous pretty well-known times of buying. For example, in 2017, when Berkshire and Warren Buffett were accumulating their big stake in Apple, they invested about $20.3 billion into the purchase of equity securities for the full year. But those investments were almost completely offset by the sale of about $19.5 billion of other stocks that they owned at the time. But this time around, Buffett is really putting a big chunk of that notoriously large pile of cash to work. The amount of cash and short-term treasuries across Berkshire Hathaway's subsidiaries at the end of December 2021 was $146.7 billion. That cash pile is now down to $109 billion as of the end of September 2022. And in Buffett's case, the overwhelming majority of that cash has gone towards two large US oil companies, namely Occidental Petroleum and Chevron. In this video, I want to give a bit of a refresher on kind of the long-term supply and demand dynamics for these large oil companies. I also want to talk through a couple of the reasons why I think that Buffett is really interested in Chevron and Occidental. And I also want to tackle the somewhat difficult topic of calculating intrinsic value for a business as volatile as an oil company. So if you enjoy these types of videos, be sure to subscribe to the channel so that you can see future content as soon as it goes live. But without further ado, let's get straight into the video. Now, firstly, just a quick refresher on some of the long-term oil supply and demand dynamics. This is something I've covered in a bit of detail previously here on the channel, so I will leave that video linked down in the description below. But your success in terms of investments in oil companies are definitely very heavily influenced by the price of the oil commodity, and that's something that Warren Buffett has told us before. So if we look firstly on the demand side for oil, simply looking at some of the basic statistics around global oil use, it looks like oil really continues to truck upwards in terms of demand by a couple of percent a year, and that trend has gone on for a very long time. It pulled back a little bit in 2020 when the world shut down and really decreased its use of fossil fuels, but we've since bounced back from that, and forecasts are that oil demand continues to grow despite the countless number of sustainability initiatives going on around many different parts of the world. Now, of course, the world will have to transition away from oil at some point, and there's a lot of capital being invested in that space. But I do think one of the core reasons Buffett is likely invested in these oil companies is that he expects the transition to probably take a lot longer than most people anticipate. Now, in terms of oil supply, typically that is pretty heavily dictated by price. As oil prices go up, oil companies tend to produce more oil to try and capture those high prices. And as oil prices go down, oil companies tend to supply less oil to the market because it's not as economically attractive. And recently, oil prices have come back somewhat, although generally speaking in 2022, we've been experiencing very, very high oil prices. And there's a saying in a lot of commodity businesses that generally speaking, the cure for high prices is high prices. And that's typically because it incentivizes companies to bring more oil production online. But right now, there are really two main things at play that are potentially stopping oil supply from coming online as quickly as it might have done historically. Firstly, it's very political, and I don't want to get into a whole bunch of politics in this video, but the point is there's not a whole lot of politicians in many developed parts of the world going out and encouraging companies to drill for more oil. And I think this kind of funny clip with the White House press secretary actually sums it up pretty well.
Okay. Thank you, Kareem. So you're asking oil companies to further lower gas prices. What makes you think that they are going to listen to an administration that is ultimately trying to put them out of business?
How is the administration trying to put them out of business?
Well, they produce fossil fuels, and this president says he wants to end fossil fuel.
So look,
There's a couple of other things at play in terms of the investors in these oil companies. Firstly, we've come out of a couple of really interesting phases of the oil cycle. In 2007 and 8, the last time that oil companies really rocketed up and oil prices were very high, there was a lot of incentive for oil companies to grow and to deploy capital in finding more oil. And that really caused quite a significant oversupply in the oil market. It meant that oil prices went down, and really there were a lot of investors burned from encouraging companies to go through that exercise. So there's been a real shift, and if you listen to the likes of the Occidental quarterly conference calls, you'll no longer hear them talking a lot about finding new oil and spending a lot of money on capital expenditures to drill more wells and so on. You'll instead hear them talking a lot about debt repayment, about share buybacks, and about paying dividends to shareholders. And finally, there's some research that I covered in a previous video here on the channel that suggests that over the very long term, if oil were to get below the, say, $40 to $60 per barrel range, it would really no longer be economic for most oil companies to exist. So anything can happen in the short term with all sorts of commodity prices, but that probably is some sort of very long-term floor for oil. So to sum up where I think Buffett's head is probably at, if I really had to guess, I think there's probably two core factors really at play when he's investing in the likes of Occidental and Chevron. I think firstly, he probably has a view that oil prices stay higher for longer than most people anticipate. And secondly, I think he really likes the capital allocation taking place at these companies. Limited capital expenditure for growth and exploration, and a lot of cash being funneled back towards shareholders through debt repayments, dividends, and share buybacks. And to an extent, I think that second capital allocation point probably reinforces the first point of oil prices staying high. If every company is just doing a bunch of share buybacks and paying dividends and no one's spending money on looking for new oil, that is another kind of big constraint over the long term on oil supply. Now, I recently actually got the chance to sit down and interview Jake Taylor, who some of you may know from the Value After Hours podcast. He's also the CEO of Farnham Street Investments and the author of The Rebel Allocator. The full podcast episode with Jake will be going live probably later this week on the Investing with Tom podcast YouTube channel and on all audio platforms as well. And I just want to play a clip of something that Jake said in that podcast episode, really exactly on some of the points I've been discussing in this video.
Like I'm very hopeful that humanity will make the transition from hydrocarbons to more renewable sources of energy. And I think we will get there eventually. I just think it's going to take a long time. And as an investor, if everyone thinks it's going to take a short time and you think it's going to take longer, that has often been a pretty good bet to make, is that things take longer than everyone thinks.
Now, we all know that Warren Buffett is a value investor. Anytime he's looking to buy into a particular company, and oil is no exception, he's looking to buy that business below its intrinsic value. And he actually mentioned specifically in the 2007 annual shareholder meeting for Berkshire Hathaway how he thinks about investing in oil companies. He said, if we are in an oil stock, it's because we think it offers a lot of value at this price, but it does not mean we think the price of oil is going up. If we thought oil was going up, we could buy oil futures, which we actually did once. So how exactly does Warren Buffett calculate something like intrinsic value for an oil company? Because these businesses are very different from a Apple or Microsoft or Costco, which are very steady businesses that produce stable and growing amounts of cash flow and earnings. Oil companies are quite different. They can be very, very volatile, and their earnings year to year are heavily influenced by the price of oil. Again, I want to play another clip here from my interview with Jake Taylor, where he presents a pretty nice idea of thinking about valuation with some of these very cyclical businesses.
I think ideally in like that type of commodity company, you probably like buy on price to book and sell on PE. So wait until you buy when the business isn't working, assuming that you know that it's a cyclical decline and not a secular decline, and that is not always obvious. So, as you know, a lot of people could attest to buying companies that they thought were just at a temporary dip, and then they never come back. I know no one wants to hear that, even though we've been sort of in a buy the dip mentality for a dozen years plus, but sometimes they don't come back. So if you can untangle secular versus cyclical, and you believe you're cyclical, I think buying on a cheap price to book basis can feel like you're not taking undue risk. And then when to sell, more difficult question. But I think, I think you want to imagine what can the earnings look like at when things are working in this business, and what would be a reasonable multiple of those earnings, and then not be too greedy about it, and not overstay your welcome if you can help it.
So buying on price to book and selling on price to earnings, I think, is actually a really nice framework. There's another saying in very cyclical businesses that, cyclicals often look cheap at the top and expensive at the bottom. And that's because when cash is really kind of rocketing in the door and these businesses are doing very well, the price to earnings ratio, for example, tends to look really low. They might trade at, low single digit multiples of earnings. And then when these businesses are bombed out and not really earning any money, they'll tend to trade at really high multiples of earnings. Even though the stock price may be down a lot, they're just making so little money that something like a PE ratio can make those businesses look expensive when they're really probably not. Book value, however, and the price to book is actually much more stable, and there's certainly a lot of companies where a price to book is just completely meaningless. For very capital light tech businesses, for example, their earnings potential is really not dictated by the amount of assets and liabilities that they have on their balance sheet. Rather, there's a lot of intangibles like brand or like software that really drive those businesses' earnings. But for many companies, the assets and liabilities and the book value that company has is directly related to the amount of cash they can earn. Take a real estate company, for example. The only way for a real estate company to earn more money over the long term is to own more real estate. And the only way for a bank to earn more money over time is to grow its balance sheet and have more capital and be able to write more loans and take on more deposits. One of the main ways that a farming company will be able to grow its earnings over time is to have more assets in farmland, and one of the ways that an oil company can make more money over time is to have more money in land where they can drill for oil. So for that reason, although a single year price to earnings can be pretty meaningless for a lot of these really cyclical companies, looking at the assets and the liabilities and then the book value on a company's balance sheet can be a very useful way to go. Take Occidental Petroleum, for example. Even though its earnings have been very volatile, it's generally traded somewhere in the 2 to 3 times book value range. And when markets have gotten quite dislocated and there's been a lot of fear around oil companies, take in early to mid 2020, for example, when oil briefly went negative, the price to book on Occidental got right down to about 0.35, which is a tiny fraction of where that multiple sits today, of closer to about 3 times book value. So trying to value a really lumpy commodity business like an oil company can certainly be challenging, but Buffett tells us that he is still looking to buy businesses below their intrinsic value, even if they are these really lumpy commodity businesses. And although many people are fans of the discounted cash flow and modeling forward future earnings and steady growth and so on, that's really just not reality for a lot of these commodity businesses, where the short-term kind of price movements in a particular commodity are often just completely unpredictable. We really have to find something else to kind of attach to and anchor on when we're trying to value these businesses. And luckily for us, the long-term earnings power of most of these commodity type businesses is going to be pretty strongly linked to the assets and the oil wells and the mines, or whatever relevant asset that company has. So there are a few thoughts from me on some of the long-term supply and demand dynamics for oil. Some thoughts from Jake Taylor, which I found really interesting on, Buffett's kind of bet on some of these oil companies, and also some of the ways to think about valuing these really volatile commodity businesses. So I do hope you enjoyed the video. Be sure to keep an eye out for that full podcast episode with Jake on the Investing with Tom podcast channel coming up soon. But I hope you enjoyed this video, and I will see you in the next one. Cheers.